Yes. This is the basic structure of candle versus bar. I'm not going to go through this much because you probably all know what this is. But this is a simple OHLC, or open, high, low, closed bar. As we can see here, it opens on the left, closes on the right. Okay, and then we have the low near the low at the bottom, and the high at the top. So we have the open, high, low, and close. Now the candlestick has exactly the same information. Okay, the open is either the bottom of the body or the top of the body. The close is is the other side, is either the top of the body or the bottom of the body. The high is the very top of the wick, and the low is the very low of the wick. Okay, and this is for each period that we're looking at. So, for example, if this is a daily candlestick, we're looking for the open, high, low, close on a daily price action. Now, if we take a look at this candlestick, very simply, for those of you who are not familiar with this, we have it's based on colors. So usually you have either white or black. Okay, white or black, or green or red. Green and red. Okay, so if you have the white and black color scheme, then what we're talking about is a white candle, a white body is a net bullish body. That means it opened on the bottom and it closed on the top, and that gives you a visual representation that that was a net bullish candle. Okay. By the same token, a black body would mean that it opened on the top and closed on the bottom. That's a net bearish candle. Now, if your charting platform has a different color scheme, and this is the one mine has, it's green and red. So that means if it's green, it's a net bullish candle, which means it started down here, it opened down here, and it closed up here. That's a net bullish candle. If it's red, that means it's a net bearish candle. It started up here at the top of the body, and it closed at the bottom of the body down here. Okay, so just a quick refresher for those of you who are not familiar with what candlesticks are. Okay, so how does it give you a good visual representation? Well, essentially, what it shows you by colors, it shows you we have a net bullish day or we have a net bearish day. If it's a net bullish day, that means the bulls essentially won out over the bears. If it's a net bearish day, that means the bears won out over the bulls on a net basis for that particular period. Okay, so enough of that. Let's go forward here. Okay, these are the common forex candlestick patterns. Like I mentioned before, they're all very, very simple. Okay, sort of by in the order of importance for me at least. These are the candlestick patterns that I look at, and I'll show you visual representation in a second, and then I'll go to my charts and show you exactly what I mean. Okay, so we have the hammer and the shooting star. Those are very, very important to me. Okay, and especially if those occur at support and resistance levels, and I'll show you in a second. Now, we also have hanging men and inverted hammers. We have doji, which are also very important. They talk about potential indecision in the market. We have spinning tops, which are sort of similar to doji. We also have multiple candlestick patterns, including the bullish and bearish engulfing patterns, harami, and there are many, many others, but these are basically the ones that I'm looking at on a daily basis in order to combine with the other elements of technical analysis to provide me with potentially high probability opportunities to enter and or exit any given trade. Okay. These are the visual representation of single candle patterns. Okay, now, of all of these here, the most important ones, as I mentioned, are the hammer and the shooting star. Why? Well, I'll show you. It just makes a lot of sense, and it really, really, tends to work when you combine it with the other elements of technical analysis. So if you take a look here at the hammer, what is this? It's simply a downtrend. Okay, we have a downtrend. We have these net bearish candles. Okay, a move to the downside. This candle here, which is called the hammer, is simply it started up here on the very top of the candle. Okay, it opened there, and then it closed just below that. So that has a very small body. Okay, but in the middle of this, in the meantime, what it did is it went all the way down to a low, and then came all the way back up. What does that mean? That represents price rejection, price failure. If this occurs at or near a support level, that for me is a very strong potential signal that perhaps we're having price rejection and a move back to the upside. This downtrend is not able, or it doesn't have the strength. The bears don't have the strength to continue this downtrend, and we're getting rejected and moving back to the upside, and the downside momentum is losing out, okay? And then you have a potential for a turn to the upside. Same thing with the shooting star, but in different, the different. We have an uptrend on the shooting star, and then we have a candle where it opens at the bottom and then goes all the way up and comes back down and closes near the bottom. So we have a very small body and a long upper shadow, a long upper wick, and that shows rejection near the highs. This momentum is losing out. This upside momentum is losing out, comes back down. There's rejection, there's price failure, and if it occurs around a resistance level, a very strong potential indication that perhaps there's loss of upside momentum and perhaps there might be a reversal to the downside. Okay, so hammers and shooting stars, I don't care what you call them. Just look at it visually. You don't have to worry about the names of these, but look at it visually. That's what I mean. Okay, and then over here on the very left-hand side, the doji. It simply means that price action for that particular period opened at a certain price. It went up, it went down, it went down, it went up. We don't know which first or last, but it went up and down, and then it closes the period right at or very near where it opened, and that shows potential indecision in the market. Okay, so that's what's called the doji. There are many different types of doji out there, but essentially they have the same principle: open and close at or very, very near the same price level, and in between a movement up, move down, it represents indecision. Same with spinning top, or very similar with the spinning top. We have a small body here. We have a long upper wick, long lower wick. That talks about also potential indecision. We have moves to the upside, we have moves to the downside, we have conflicts between the bulls and the bears, and finally end up right around near where we open the period. That is potential indecision as well. Okay, these two are not as important for me because they don't have as strong of a visual representation as the others, but here we have the hanging man, which is simply a small, for an uptrend, we have a small upper body, a long lower wick, also potential indecision in the market, potential turn to the downside there. Inverted hammer, we have a downtrend here. We have a candle with a small lower body, long upper wick, also potential indecision in the market there. These, again, the hanging man and the inverted hammer, not nearly as strong for me in terms of the signal they produce or the indication they produce than, as the hammer, the shooting star, and the doji as well. Okay, so hopefully you got that. Okay, those are the single candle patterns I use. Again, very, very simple stuff.